We need more weaponry. We need more artillery. Artillery matters when starting those kind of campaigns. We need ammunition. Necessary ammunition for the Western artillery and for the old Soviet artillery.
Any kind of private equity strategy that was based on leverage, right, is going to be challenged. But many of them are based on growth. And companies, especially as you have technology companies, those aren't as reliant, and it's not as risky on the, from the interest rates rising. To globalize our alternatives platforms, Alcentra was a move of taking a U.S. private credit manager and adding European capabilities. So if there were some geographies that made sense for us, we'd be interested there, or specific fintech type of strategies that we thought were interesting from distribution, we may be buyers and things like that.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Power down, the EU moves closer to power rationing and is set to propose a levy on energy company profits. Prices down, stocks extend gains leading into today's U.S. CPI print, with the headline number likely to feed optimism that inflation has actually peaked. Plus, slimming down, Goldman and HSBC plan staff cuts amid economic uncertainty. UBS boosts its dividend and buyback. Now, first of all, good morning, everyone. Let's check on the markets. Of course, it's all about that CPI print in the U.S. John Arthur is writing a beautiful piece today saying, look, even if we have CPI peaking, even if we are expecting a bit of a lower CPI print than we had in the 3 months before or the month before, the concern is that markets are not pricing in how aggressive the Fed need to be still with hikes if they want to get that 2% level under control. Euro dollar 101.45. Yesterday was a big day for euro strength, or certainly not weakness that we saw in the last couple of weeks. U.S. 10-year yield 3.321, and we have Bitcoin, but we'll probably change that to something else like sterling. We also had that UK employment figure in the UK. Not all good news. It's lower than expected, but this is because a lot of people actually also fell out of the workforce. So let's look at the map to see the difference, for example, between the FTSE and what we're seeing elsewhere in Europe. The FTSE gaining 1% or 0.1%, 0.1%. The CAC 40, 0.6% higher. So U.S. CPI data for August out later today. The headline figure expected to have cooled to 8.1% year on year. It's a last big dose of economic data before the Fed meets to decide on further rate hikes. Well, Treasury Secretary Janet Yellen spoke about the issue yesterday.
The Fed is going to need great skill and also some good luck to achieve what we sometimes call a soft landing. My hope is that we will achieve a soft landing, but Americans know that it's essential to bring inflation down. And over the longer run, we can't have a strong labor market without inflation under control.
To talk about the markets and inflation, we're joined now by Karim Chedid. He's head of investment strategy for iShares, EMEA at Blackrock. Karim, as always, thank you so much for joining us. Okay, inflation. We're expecting it to peak, but even if it peaks, does the market need to correct because hikes are going to be more aggressive?
Yeah, I think so. I mean, even if it peaks, when we look at the breakdown of the number that's likely to come through today, we have some signs of easing at the headline because of the fall in energy prices from the highs, and some signs of easing in manufacturing, because we've seen, supply disruptions have been improving, but the services sector still has pressure. When you look at shelter costs, for example, still a lot of pressure there, still broad-based. So I wouldn't, even if we have a drop at the headline and some parts of inflation today, I wouldn't call it really over for the hawkish rhetoric, and the market isn't really priced for that.
This is a concern. So our Valerie Teitel put some great graphics together, and I'm looking for the numbers because they kind of really cement some of the anxiousness that the market is looking at. First of all, CPI month on month. But then if you look at, for example, some of the U.S. inflation, and we're looking at the New York Fed survey, it really shows substantial declines in inflation expectations.
Yep.
So there's a concern that the market is not pricing in what the Fed needs to do to get to 2%, or that they're overly optimistic about these inflation figures.
Absolutely. And when you look at the real yield, I mean, it's gone up quite significantly. So inflation expectations have come back down. And we see this as an entry point to go back into exposures like TIPS, inflation-linked bonds, because the market has gone a bit too far.
Okay, so when do you expect that? Is it a correction that we're expecting, or when do they realize?
Well, I mean, they'll realize when, obviously now we're in the blackout period, we have the meeting on September 21, which will be an important flashpoint. They'll realize maybe more gradually. So I think there will be some, I don't think it will be an abrupt correction, but rather there will be gradual repricing, which we should position for.
All right, let's look at the two-year break-evens approaching the Fed's 2% objective. So that's another great chart that our Valerie put together. 10-year hits a 4-week low. There's a conviction on the markets that actually the Fed has this, that they can manage this. Are they wrong?
Well, I mean, the Fed is being very clear that at the moment they are focusing on bringing inflation down and powering ahead with the rate hikes. As we look to 2023, we do see them powering ahead and not pivoting yet. I think we'll need to see more demand destruction. We'll need to see more signs of recession before the Fed gets anywhere nearer to a pivot. So there is an element of long-term expectations and mid-term expectations coming down because of fears of a recession. So the market is adjusting to that. But for now, the Fed is staying with the hawkish rhetoric and not pivoting.
So, Karim, what kind are you expecting, a shallow recession, or is there a danger that as we try and manage this recession, it becomes quite ugly, or there's a snowball effect, and actually we'll see a huge correction also in stocks?
I would say more of a shallow recession. So we do see the Fed at some point, once seeing signs of demand destruction and recession, we do see them pivoting at some point next year. It's just that the pivot is not as early as the market is pricing at the moment. I would say more of a shallow recession. In Europe, it's probably more protracted. Yeah. In Europe, we could have already entered it because of the food and energy shock. We're looking at more of a multi-quarter recession in Europe, maybe even up to 6 quarters. So definitely more protracted picture. But in the US, more shallow.
Thank you so much, Karim Chedid there, from Blackrock, stays with us. We're also getting some breaking news out of the German Chancellor. He's Olaf Scholz, saying the power price cap will be implemented with great speed. So we'll talk a lot more about energy prices shortly. Also coming up, Beijing looks to boost consumer activity to help compensate for the dwindling tourism revenue and economic slowdown. More on this after the break. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now over to China, where the Premier, Li Keqiang, has called for more policies to drive up consumption in the economy. The latest figures really show a further plunge in travel and spending over a 3-day public holiday amid tight COVID controls. Now for more on all of this, we're joined by our Chief Asia Economics Correspondent. He's Enda Kern. Enda, thank you so much, as always, for joining us. So what's the latest read on China's economy?
Well, we had a pretty soft read, as you say, on the all-important tourism data over the Mid-Autumn Festival. Francine, the read was about just over 20% down compared to a year ago, and well down on pre-pandemic levels, just speaking to the idea of restrictions and lack of mobility around people travelling around in what would normally be a fairly busy bumper time for consumer spending. But then we had the readout from the State Council, like you mentioned, Premier Li Keqiang talking about the need to boost consumption and boost demand in the economy. There was some discussion of speeding up spending on infrastructure projects in that. Now, economists were fairly subdued in their reaction. They didn't think there was much new by way of a new signal from the government or new policies announced by the government. But it does speak to the idea that the authorities are trying to roll out whatever measures they can to at least put a floor under things.
So, Enda, do we know if the economy has bottomed at this point?
Well, on Friday, we're going to get a big read on where the economy is at, Francine. We'll get industrial production, we'll get fixed asset investment, and we'll get retail sales. It's expected to be something of a mixed bag. There may be a pickup in retail sales, industrial production flatlining, but all of the kind of consistent data on China's economy continue to be negative. We know inflation is very weak, reflecting very weak demand. We know that exports are now coming off the ball. Remember, exports were the big success story of China's COVID-0 pandemic over the last few years. That's now coming off. And we know that the broad real estate side of things remains in something of a slump. So this week people will be looking to Friday's data to see, does it at least suggest a bottom, but nobody's certainly calling a turn in the economy for now.
So, Enda, thank you so much, as always, for all of the insight. I know we'll get back to you and also talk about renminbi shortly. Enda Kern, their Chief Asia Economics Correspondent, with the very latest on China. We're back with Karim Chedid from Blackrock. Karim, I don't know how you play China or whether really there's going to be a change, not in leadership, of course, but in policies after, the big political gathering into the new year.
I mean, how we look at China really is a source of diversification. Everything we just heard from Enda, you can tell that China is in a different cycle than in DM economies. So the cycles have somewhat desynchronized, and that's both at the level of the economic cycle as well as the central bank cycle. You know, the PBOC is in a very different place to the Fed and the ECB and all the other hawkish central banks. So desynchronization is the name of the game, which means that the drivers of asset prices in China are different at the moment.
So does it mean that it could be a bargain actually swooping up? And I don't even know how you play it. Is it only currency?
No, I'm also looking at the assets. If you look at China equities, for example, they have been very lowly correlated with DM equities in the past couple of quarters. You know, when you had the rally in stocks over the summer in DM, China was underperforming. When you had the sell-off in Q2, China was outperforming. This is what I mean by diversification. Okay. It goes in the other direction. And then with China bonds, I mean, obviously they now trade at a premium to US government bonds, and that has ramifications on how you seek China bonds for income, but they've also been a diversifier in that the correlation is low.
Yeah, I guess one of the assets of concern is regulatory concerns, right, which was really the story in China over the last 2 years. How do you get around that?
So on the equity side, I think we've seen some peak regulation in tech, so we've kind of gone down from the peak here, and then in other parts of the economy, of course, it is a risk. So this is a risk premium that investors attach to owning these assets.
Karim, talk to me a little bit about Europe. So we just had Olaf Scholz saying, look, we have to have great speed in putting these price caps.
Yeah.
How difficult will the winter months be? We're also starting to hear stories, for example, in the UK of a school having to close down at 1 p.m. because of the cost of energy.
Yes, so Europe is a really mixed bag at the moment. On the one hand, in the near term, we're seeing some positive sentiment coming through in equities. I mean, in September alone, stocks are up 4%. And I think a lot of it has to do with how extreme the short positioning has gotten in European equities, across institutional and hedge fund money. Very, very big outflows we saw over the past 8 weeks. So it's getting to points where some are looking to dip their toes back in. But on the other hand, as you say, the winter is going to be tough. We still don't know how the rationing is going to look like around energy. The price caps should help, but at the same time, you might be getting a bit more core inflation with more price caps, which means that the hawkish rhetoric from central banks remains. So headwinds still.
So again, how do you play that? And what does it mean is it through currency or stock, or actually do you get into fixed income?
I think it's through fixed income. So looking at Europe investment grade credit, those spreads we think are compensating us better than the valuations in equities are. So from a cross-asset perspective, definitely prefer IG credit in Europe. And then in stocks, going granular. So looking at sectors like banks. Banks are starting to look interesting because their valuations are so cheap, and from a net interest margin perspective, they have some tailwinds as the ECB rates go up. So going granular is the way to go.
Italy? I mean, to Italy or not to Italy? We covered, of course, the stepping down of Mario Draghi as this big market event.
Yes.
We go into the election about 10 days, and frankly, the market are completely ignoring this.
Yeah, they are. I mean, there is still some risk. I think it's interesting to see how stable spreads have been in Italy, in Italian bonds after the significant underperformance earlier this year. It's probably not as much of a market risk event as was expected by markets a couple of months back, but I think it's hard to call it as the re-entry point.
So what is the re-entry point?
So I think for Italy, it would be more, once we've passed the election, and obviously we have more tools from the ECB now around spread containment, which do have a pretty high bar to clear to be used. So for Italy, I don't think it's now. I think it's more in 2023 once we have a bit more clarity about European risks. But for other parts of the European market, like banks, we do see the re-entry as now.
Karim, thank you so much for all of the insight. Karim Chedid, their head of investment strategy for iShares EMEA at Blackrock. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The EU is set to propose a mandatory target to cut power use. The move is a step towards rationing energy to help homes and businesses across the continent survive an energy crunch. Other measures include funneling energy company profits to struggling consumers. The EU's executive arm will propose its package this week, though deep divisions do remain among its member states. Now, Ukraine is seeking more weapons along with continued US support to build on successes in retaking territory from Russia in the Kharkiv region. A senior Ukrainian official told Bloomberg the armed forces also need armored vehicles and tanks to secure victory over Moscow.
We need more weaponry. We need more artillery. Artillery matters when starting those kind of campaigns. We need ammunition, necessary ammunition for the Western artillery and for the old Soviet artillery. We need armored vehicles and tanks because you see how important to have enough armored vehicles and tanks to carry the manpower. So definitely we need more and more weapons from our Western allies to get our victory as soon as possible.
And hundreds of New York Times staff are working from home this week in defiance of the company's renewed return to office push. More than 1,200 people have pledged not to return to the office in an effort to get the paper to negotiate over its plans. Journalists are also saying many staff have not had a pay rise for 2 years, and that's despite soaring inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, the UK remains in mourning. Thousands of people have queued to pay their respects to the Queen. But while politics is on standby, the economy is not. So we'll have plenty more on that next. And this is Bloomberg.
Wall Street prepares for the latest read on inflation.
Things are moving. The news flow is extraordinary.
Will headline inflation continue to ease?
The totality of the data has been better than expected.
Very positive movement on inflation.
Instant reaction on Bloomberg Surveillance.
This is a new era, and it is one of the most pressing concerns facing us.
And what it means for the Fed.
This inflation fever is breaking and economies keep softening.
They are on track, perhaps, for that soft landing.
Inflation in focus today on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK remains in a period of mourning. Thousands have queued overnight to pay their respects to the Queen, whose coffin is at St. Giles's Cathedral in Edinburgh. Now, while government business is on hold, the economic news continues. Data released this week paints a clear picture of how well the nation has fared amid sky-high inflation and rising rates. Now, for more on all of this, we're joined by Bloomberg's Lizzie Burden. So, Lizzie, first of all, when you look at the royals and the monarchy, of course, we're still in this period of mourning until the Queen's funeral on Monday. What can we expect today?
Well, King Charles is in Northern Ireland with the Queen Consort Camilla. He'll be in Stormont to receive messages of condolence at the Northern Ireland Assembly on behalf of the Northern Irish people. There'll also be another church service later today. It's all part of Operation Springtide, King Charles visiting all the regions of the UK. And we've had some clarification. Liz Truss is not accompanying him on a tour of the UK, as was previously reported. Actually, she happens to be at the same church services. I think officials didn't want this to be politicised. And later today, as you say, the Queen's casket will be flown to London and she'll lie in state in Westminster Hall from tomorrow, which is really symbolic given that that is the same place Charles was yesterday, devoting himself to the precious principles of constitutional government. And it was really a symbolic moment, wasn't it? Because he said he felt the weight of history because that was the same place where his namesake, Charles I, was tried for treason and sentenced to death in 1649.
I imagine, just like King Charles III has to break away from the shower with his mother, so does Liz Truss have to do the same. What can you tell us about the economy?
Well, we've had more data on the jobs market this morning. The unemployment rate at its lowest since 1974, which shows really the tightness in the labour market isn't going away. It was driven by 194,000 people dropping out of the workforce workforce. And this figure is something that governments like to boast about. Remember Boris Johnson on the steps of Downing Street when he gave his farewell, saying unemployment was at its lowest since he was on a space hopper. But actually, in reality, what this means is it's hard for firms to get workers. It's driving upward pressure on wages, even though workers aren't feeling the benefits of that because inflation's swallowing the wage growth.
And at the same time, we know that the dockers at Felixstowe did not get enough of a pay rise, so they're going on strike again.
Yeah, I had been at Felixstowe the last strike, and yes, they're going to do it again. But what's worrying is it looks like the dates will overlap with the strike at Liverpool. Felixstowe, of course, the biggest container port, focuses on Asia. Liverpool focusing on transatlantic trade. Couldn't be a worse time because retailers are gearing up for Christmas.
Lizzie, thanks so much. Our Lizzie Burnham there on the monarchy and the UK economy. Now, coming up, Ukraine vows to reclaim all occupied land as it works to build on its rapid advances in Kharkiv. We hear from a senior advisor to President Zelensky. That's coming up next. This is Bloomberg. Down, the EU moves closer to power rationing and is set to propose a levy on energy company profits. Prices down, stocks extend gains leading into today's US CPI print with a headline number likely to feed optimism that inflation has peaked. Plus, slimming down, Goldman and HSBC plan staff cuts amid economic uncertainty. UBS boosts its dividend and buyback. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Ukraine is appealing for more Western weapons to build on its successes over the weekend in liberating territory from Russian control in the Kharkiv region. Bloomberg's Maria Tadeo spoke to a senior advisor to the Ukrainian president.
The aim of the Ukrainian armed forces, the aim of the Ukrainian president is to liberate all the territory Ukraine is now is not having the control of. And in order to do this utmost task for us, in order to get the victory, definitely we need more weaponry. We need more artillery. Artillery matters when starting those kind of campaigns. We need ammunition. Necessary ammunition for the Western artillery and for the old Soviet artillery.
Ukraine says hopefully this year can be put to an end to the war. But I wonder, there was a theory for a long time that weapons meant escalation, and that was a bad idea, and that would only anger Vladimir Putin, and that would only be a problem. Would you say that at this stage, everyone who said Ukraine cannot fight back, weapons means escalation, they've been proven wrong?
Absolutely, they were fully and totally mistaken. Yes, we heard some positions even before the war. Let's not provoke the Russian Federation. Let's tame the beast. Let's be very cautious. Look what happened. Russia still started its aggression against Ukraine, and the steel weapon started to go on. But imagine if we had it before, maybe Russia would have thought twice. So now they are totally wrong, and they see. I think they understand they are totally wrong. They understand the wrongness of their position when saying Ukrainian armed forces will not be able to master this weapon.
Bloomberg's Maria Tadeo there speaking to the advisor to the Ukrainian president. We're joined by Maria now. So Maria, it was a comprehensive interview. I urge everyone to go on our website and also listen to it. Did he give any more insight into how Ukraine plans to build on the recent successes on the battlefields?
Yes, and Francine, there's a lot of secrecy now, as you can expect, from Ukrainian officials in terms of where they go and where the army moves. They feel a lot of the success they had is because they moved in small units, that actually caught the Russians by surprise. But I think the takeaway message now from Ukraine, and expect to hear this a lot from the Ukrainian administration, is that this is an army that is professionally trained, that knows how to operate NATO weapons, and the key to ending the war will be more supplies. This is something they will continue to repeat on and on and on and on. Yesterday, who advises President Zelensky, said it is time the West changes their mindset. Weapons do not mean escalation. It's the only way that we'll be able to force Vladimir Putin to the negotiating table. Only when you push him on the military front, you're going to get a diplomatic solution out of this.
Maria, you also asked him about the situation regarding the threats hanging over Ukraine's massive nuclear plants.
And Francine, this goes back to Zaporizhzhia. The situation there is almost, I guess we can agree, surreal, but incredibly scary, but also very dangerous. What you have here is a plant that is operated by Ukrainian staff, but is controlled and has been for weeks by the Russian army. The Russian army says the Ukrainians continue to shell the plant. The Ukrainians say it is the Russians. There is very little communication between the two sides. We have seen that over the phone. President Zelensky is talking to President Macron. Macron then goes back to Putin. The Russians, the Ukrainians do not talk directly, and the idea is to demilitarize the plant, but so far that's not been the case. The Atomic Agency says the situation is now reckless. Everyone should calm down, remove their weapons, and stabilize the situation.
Maria, thanks so much. Our Maria today there with the very latest on Ukraine. And we're also joined by Domitilla Sagramoso, Senior Lecturer in Security and Development at King's College, London. Professor, thank you for joining us. When you look at some of the concerns surrounding, of course, this long-lasting war in Ukraine, we're at, I think, day 200, and there were significant, impressive moves, actually, from the Ukrainian army on Russia over the weekend. What does this mean longer term?
Well, I think this was so significant that we are really now starting to think that many other sort of Russian fronts could collapse. I mean, it is really quite interesting that there was talk that some units were surrendering on the Kherson front, which is on the south, not far from Crimea. And that would be particularly significant because it would allow Ukraine potentially to be able to hit targets in Crimea. There is also talk that Ukraine could advance in areas that would lead to Mariupol and liberate that area, and maybe sort of through a pincer movement also challenge the Russian military presence in Crimea. There's been also advances on the Kharkiv front. So it's a very significant moment. I think what is really important for the Ukrainians now is what we call sort of consolidating their positions. So making sure they have the necessary sort of defensive capabilities and defensive positions so that they're not sort of overrun by the Russians again. I think it is the Russians are, excuse me, yes.
No, Domitilla, is there a concern that actually because of the advances, the West now thinks, that this will go their way, and actually we don't know how Vladimir Putin will react to it?
There is a problem. I mean, the Russians are facing problems, as we know, with equipment, materiel, and so they tend to, and also with manpower. That's one of their biggest problems because they're not calling for full mobilization, and they do not have really the means to develop an effective army in the short term to replace the losses. So there is a lot of concern that Putin will sort of rely on sort of indiscriminate attacks and hitting infrastructure, as happened on Sunday evening when they hit a thermal power plant not far from Kharkiv, and that left many areas sort of in a power blackout. So there is concern that Russia might carry out this kind of indiscriminate attacks. There's always a question whether Russia would escalate to the use of nuclear weapons. I mean, we never know, but I personally think that that is quite unlikely because the Russians understand that, they would face retaliation from the Western side, and that would make it very hard for NATO countries not to intervene in some way. So I think there is a sort of red line. So Putin is in a very difficult position at the moment.
So, Domitilla, how do you see this ending? Do you see this actually, staying as a protracted war, or could this end quicker?
I think that if the Ukrainians get the right weaponry and the right support, I mean, they could continue advancing, and we could see the Russians really suing for negotiations. And I think that is really what they're probably looking at the moment, that there is some kind of negotiations that fixes the lines that they have now. There is still a lot of territory that is under Russian control. I mean, we got really excited, and we thought this was going to be sort of the end of the Russian occupation. But I think we have to be also very cautious, because there's quite a lot of territory that is still under Russian occupation. So what I would expect from the Russians is, if they cannot muster significant forces to sort of overturn the Ukrainian gains and then move further in areas like the Donbass and properly protect Crimea, that they would try in some way to find a negotiated solution. I think that is probably, we might not hear about it sort of openly, but I think it's already happening. I think there are sort of hints that, there are possibility that some kind of negotiation could end that. The problem that the Russians face and the Putin faces is that there is strong opposition from sort of the more nationalist quarters to call full mobilization, to carry out really war in all fronts, even against the West. And that is dangerous, because this pressure on Putin is quite strong at the moment.
Domitilla, is there a danger that actually, as we get into the winter months, and I mean, this is a danger, but is it a real danger that because the cost of living crisis will get harder, because the gas prices will go much higher, that actually there's going to be the West, and especially certain countries in Europe, that will turn against spending more money and sending more weapons to Ukraine?
Yes, I think that the real concern, as was mentioned earlier, is, of course, a question of energy and the supply of energy from Russia to Europe, gas in particular. I think that is a weapon that Putin uses quite effectively. He's done that in the past towards countries such as Ukraine, Armenia, Belarus. So he uses this as an instrument of policy. He wants to achieve results by sort of putting pressure on the energy front. And I think that is what he's going to use to reduce the possibility of the delivery of weapons from European countries. But I think there are those like the Polish, the Balts, the Danes, the British, the Americans, who are not going to stop with the delivery of weapons. And I think that the situation is such that we are understanding that there is a possibility that Ukraine sort of wins on the ground and on the terrain. Yeah. That is why these changes and this sort of Ukrainian advances are so relevant, because they show that there is a possibility of a turning point, and that it's not, this weaponry that we are delivering is not sort of useless. It's not sort of just keeping the lines. It's also helping with a counter-offensive. And I think that is why this is so significant.
Domitilla, thank you so much for the terrific briefing. Domitilla Sagramoso, their Senior Lecturer in Security and Development at King's College London. Coming up, Wall Street looks to be embarking on job cuts in order to meet cost targets. More on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Shares in Australia's Ramsay Healthcare have tumbled by the most on record after a consortium led by KKR indicated it won't improve the terms of its takeover proposal. KKR has been in talks with Ramsay, which operates a network of private hospitals across Australia and Europe since April. Now, Twitter has rejected a third attempt by Elon Musk to cancel his agreement to buy the social network a day before shareholders voted on the $44 billion deal. According to the filing, Twitter says Musk's latest move is invalid and wrongful. The billionaire says the company's treatment of a whistleblower gave him another reason to walk away from the deal. And Wall Street banks have kicked off the second part of a $15 billion debt package for the buyout of Citrix Systems. Bloomberg has learned that a group of lenders led by Credit Suisse will hold an investor call later today for a $4 billion secured bond offering. The financing is widely seen as a bellwether for high-yield markets. Hundreds of New York Times employees are working from home this week in defiance of the company's return-to-office push. More than 1,200 unionized employees pledged not to return to the office. They're trying to get the Times to negotiate over in-person work mandates and to agree a new contract. The Times says it has offered a new wage proposal. Deloitte is forecasting that the U.S. retailers will see slower sales growth this holiday season because of inflation. The consulting firm expected a 4 to 6% increase in holiday sales. Higher prices are expected to drive more consumers online to search for deals. And that's your Bloomberg Business Flash. Francine.
I mean, I love it when Christmas is so close that we're still like 8 months away, but people start talking about it. It's almost as good as Halloween.
And I haven't even started my Christmas shopping, Francine, and that's just the extra stress of it. But I have seen that some of the shops here in the UK are already stocking Christmas biscuits and chocolates. So there we are. We're not far away now.
I feel like I contributed actually to the trade concerns, and because I hogged and I bought Christmas presents so much in advance, Leanne, that this time, for the good of the economy, I will not do that. Now.
Oh, the problem, Francine, you buy them in advance and you forget you bought them, and then you buy more and then you find them, and it all gets very complicated. Last-minute shopping.
Yeah, lists is what I do. No, thank you so much, Leanne Gerrans. Now, soaring inflation and a slump in investment banking revenue are forcing banks to tighten their belts. Well, Goldman Sachs is about to embark on its biggest round of job cuts since the start of the pandemic. Now, HSBC's CFO says the bank is eyeing what he calls brutal cuts. For more on this, we're joined by Bloomberg's Tom Metcalf. So, Tom, thank you so much for joining us. First of all, run us through exactly the pressures that HSBC and Goldman's are facing.
Yeah, it's two probably slightly different things. So I think at HSBC, inflation really is front and centre. So you had the CFO yesterday saying, look, we're struggling to meet our cost-cutting targets because of this unexpected surge in inflation. So it's a really fascinating dynamic there, because obviously they're trying to increase the wages of their bankers to keep up with inflation. At the same time, they're going to be needing to cut in costs, including presumably jobs, to keep it within their target. So very tricky environment they're in. And obviously Goldman, that's affected Goldman as well. But I'd probably say their job cuts, which were sort of reported yesterday, are probably more likely to be driven by this big fall in investment banking revenue this year.
So what does it mean? They're cutting jobs but paying the people they need more? And are we going to see more banks do the same?
Yeah, I think, for HSBC, it's kind of that tightrope act of, hey, we need to raise people's wages. That hurts our costs. So as a result, we need to actually cut our headcount, perhaps, of employees we feel we need less. So, and I think you'll see that across all the banks, really. Anyone employing thousands of people. We've seen the UK banks come out with sort of temporary increases in their wages, and maybe those will stick if inflation proves more than transient.
Tom, what can you tell us about UBS?
Yeah, interesting story today. They are upping the dividend they're planning to pay back to investors. Basically, that comes from that Wealthfront acquisition. It's a $1.4 billion deal. They actually scrapped it because of the volatile markets. And now they're saying, to shareholders, hey, we're going to use that money we were going to spend there and we'll return it to you.
Tom, overall, I mean, I know we're going into the winter. This is a lot of energy costs. Like, what will your reporting team be focusing on over the next couple of months? Is it really bonuses and job cuts?
No, it sounds funny, but I think it'll actually be how energy is affecting finance and the banks. So, will they have sort of the resilience of the balance sheets to sort of presumably be able to deal with those kind of wave defaults linked to energy prices? Of course, the governments might step in and try and prevent that, but that's probably the biggest worry right now. Strip out energy out of inflation, it becomes a bit more reasonable, but that whole thing is obviously, hostage to kind of geopolitical concerns. So it's going to be a very interesting 6 months.
Yeah, the tough 6 months. Diplomatically, you say interesting. Tom, thank you so much. Tom Metcalf there, of course, who's in charge of our banking coverage. Coming up, chip maker Micron plans massive investment increases just as the White House looks to boost the sector. We hear from the Micron chief executive next, and this is Bloomberg.
We announced $15 billion through the end of this decade that we'll be investing in building a new fab here in Boise. And we have been our research and development technology leader from Boise for decades. And now being able to combine it with leading edge memory manufacturing technology, this will just accelerate time to market of new technologies, new solutions for the benefit of the customers, as well as, of course, driving U.S. leadership in semiconductor technology. So this is a big day. This is a big announcement, and this is enabled by CHIPS Act, which was just signed by President Biden a month ago, because that is really important in terms of leveling the playing field. So this is very exciting. It will bring 17,000 jobs here in Idaho over the course of the rest of the decade. We will be starting production sometime in 2025. Of course, construction to start sometime in 2023. And this will be transformative. And we'll be bringing on production, of course, in line with the industry's demand.
Now, Micron, of course, already has many plants across Asia. How does this impact operations globally? Does this mean you'll always consider building in the U.S. first?
Of course, we have, as you noted, well-diversified footprint across Asia for our manufacturing. And again, CHIPS Act now enables a leveling the playing field, whereby now the production can become cost-effective with the support of grants from CHIPS and investment tax credits. So, of course, we will continue to invest in our plants in Asia as well. But when we look at the demand for memory, by 2030 timeframe, semiconductor memory demand is expected to double in terms of revenue opportunity. That requires new wafer capacity. That's why we started this plant here, announced this plant here, and actually had the ceremony that launches the construction for this plant. And this will basically enable us. This will basically enable us to meet the growing demand for the 2030 era for semiconductor memory technology. Of course, we'll keep investing in technology transitions in our overseas plants as well.
Now, you and Micron warned about slowing demand about a month ago, which triggered a broader concern about a slump across the chip industry overall. What can you tell us about demand as you see it now? Is it indeed slowing down? And if so, how much?
This is for the memory industry, for the semiconductor memory industry. This is a challenging environment, primarily driven by inventory adjustments that our customers across various end markets are making. And that's really impacting the industry demand and supply balance. Of course, we have taken actions in this regard in terms of adjusting our supply growth plans for the future. But you know, Emily, very well that in semiconductors, actions taken, it takes a while before the results are achieved. So it will take us few quarters before I believe industry demand and supply and balance will be restored. But what's important here is what we are announcing today is about the long-term future. The demand drivers for long terms, AI, 5G, autonomous, and of course across data center, industrial, automotive, those demand drivers in terms of consumption of memory requirement for the long term are intact. And that's why to meet that growing demand requirement of the future, investments need to be made now, because there's a long lead time to build these fabs, and the production will only start in the second half of this decade, and it will, of course, be managed in line with the demand projections for the future.
Well, that was Micron Chief Executive Sanjay Mehrotra speaking to Bloomberg Technology's Emily Chang. Well, Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta, Kailey Leinz in New York, Tom McKenzie is here in London, and this is Bloomberg.
In the last 2 weeks, we've really seen an influx of risk-on behavior.
It's still very clear that the global economy is in a very weak phase.
The depth of the recession, which is looming right now, is probably going to end up shallower than what we could have feared.
We're in the camp that inflation is going to decelerate, growth is going to decelerate.
What I think will happen going forward is you're going to have inflation staying stubbornly higher than markets are expecting. as growth starts to turn down.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. US inflation probably slowed for a second month in a row, but that's unlikely to keep the Fed from another jumbo interest rate hike next week. A risky pivot for President Biden. He's trying to capitalize on positive economic news by turning it into an election year selling point. Meanwhile, JP Morgan says a soft landing is more likely for the global economy than a recession. And UBS will return excess capital to shareholders after the collapse of the Wealthfront deal. The Swiss bank is raising its dividend and will probably exceed a target for share buybacks. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, Kailey Leinz and Kriti Gupta in New York. Anna Edwards and Matt Miller are off today. And Kailey, the focus squarely on that CPI print out of the US later.
Absolutely, Tom. About 3.5 hours to go until we get that absolutely crucial data. But of course, traders in Asia overnight had to place bets before we got those key inflation figures. And by and large, Asian stocks did move higher. Modest gains. The MSCI Asia Pacific Index as a whole up a little more than half of 1%. But of course, following on from the gains we saw in the U.S. yesterday. Now, one individual stock, though, that was lower I wanted to point to is Fosun International. This is one of the largest non-state conglomerates in China. And Chinese authorities have asked state banks and other state-controlled enterprises to check their financial exposure to the company. So that took the stock lower by around 4% when all was said and done, though it was down more than 7% at one point in the session. In terms of other assets related to China, you had the PBOC setting a stronger than expected reference rate for the Chinese yuan, again for the 14th day in a row. And yet, once again, the Chinese yuan weaker against the U.S. dollar this morning by about 0.25%. We're trading right around 6.93, so still just shy of that really important, at least in people's imagination, 7 handle on dollar yuan. But broadly, it is a stronger or a weaker dollar story today. Stronger is everything else, including the Japanese yen, stronger by about 0.4%. Right now, crude trading right around 142.25.
Yeah, Kailey, that weaker dollar story, well, perhaps giving a little bit of a lift to futures here. S&P futures for our radio audience up about 0.4% this morning. A little bit of risk on sentiment. You can see that cross asset because when you look at the crude futures, you're looking at an 88 handle, which isn't exactly a very high number relative to the volatility we've seen in that market, but it is up 1% this morning. So we'll see, though, if that continues, if you start to see those cross asset momentum really pick up. On the flip side, though, that dollar story, once again, perhaps really a function of what's going on in the yield space. Take a look at what's happening with the 10-year yield down about 4 basis points in the early session, 331. If you are anticipating a slowdown in inflation, the natural bet here is for yields to come down as well. Let's actually see if that trade holds through. And we also should keep an eye on Bitcoin as well. That's actually where you're seeing a little bit of pain down to about 0.7%, a real divergence from what you're seeing in the cross-asset picture.
Kriti here, and you're setting yourselves up, at least if things hold as they are, for a 4-day gains across the European equity markets. Modest gains that you're seeing, for example, here on the FTSE 100, dragged a little bit lower, at least those gains not being propelled because of what's happening in the retail space. And I'll break that story down for you shortly. But you're seeing gains of 0.2%, about 0.1% over in Germany, the DAX. And talking of Germany, just fleshing out the economic story for that country, which of course is so dependent on Russian gas as those flows continue to be reduced. The ZUW Investors Expectations Survey for the month of September coming in at minus 61.9, well below the estimates of minus 59.5. So this is further underscoring the pressures, of course, on the Eurozone's largest economy. Across the benchmark then, as I said, gains of around 0.2%. Still the focus here in Europe is on those inflation data points out of the US as well. Euro, on the back of that softness around the dollar, of course, gains of 0.3% for the single currency. The energy play and what is happening from policymakers in Brussels as they square up to potentially reducing or capping prices for households and businesses remains in focus. Ocado, one singular individual story to pull out in terms of what's happening here in the UK. And this is the impact on the retail space, really feeling that cost of living crisis, down more than 11%. People are cutting back on their spend. This is a delivery company teamed up with M&S. In terms of what's happening in the banking space, a lot of stories unfolding in the last 24 hours ago. One to focus in on UBS, so stepping up those buybacks in terms of returning cash, of course, to shareholders on the back of that deal that they have not finalised. Wealthfront gaining 1.3% on the back of that news. Kailey.
All right, Tom, and we will have more on that story in just a moment. First, though, let's get a look at the day ahead on this Tuesday. First, the Queen's coffin will travel by road from St. Giles's Cathedral in Scotland to Edinburgh Airport, where it will then be flown to London. Plus, Twitter is holding a special meeting at 1 p.m. Eastern Time for stockholders to vote on the proposed acquisition of the company by Elon Musk, which, of course, he is trying to get out of. But it is the big event of the day, U.S. CPI data at 8:30 a.m. New York time. And let's get more on this now. What to expect with Michael McKee, our international economics and policy correspondent, who is here on set in New York. So, Mike, it's expected to be cooler, but that doesn't mean that it's actually going to be cool.
Yeah, you hit the nail on the head there, Kailey, because it's not so much what happened in August now that matters. It's what happens going forward. There is a consensus that we are going to see headline inflation drop and drop significantly this month, which would be good news for the economy, but core inflation is going to rise again. Taking a look at some of the components, we can see why this is happening. Food prices have stayed higher, even though the commodities came down in the month of August. We're still seeing food prices expected to rise. But two of the other categories that we've seen big increases in have started to come down. One is used cars. Remember when used cars were so expensive? Now that's come way down. And of course, the blue is energy. Energy prices, gasoline prices, way off their highs. So that'll drive some of the headline drop this month. Now, going forward, which is what matters, the Fed isn't going to pay a whole lot of attention to this because they've already pretty much locked in 75 basis points, but they do want to know what's going to happen going forward with prices. Is this continuing progress? And the problem is there's a lot of things out there we don't know. We have a railroad strike possibility. Boy, that would cripple supply chains and push prices up. Port strike possibility still out there. And oil and gas prices may rise again. That's the biggest wild card for the economy. And also drought hitting crops worldwide, raising those food prices. So while the Fed is going to do 75 at this point, the numbers today may remind us they still have a lot of work to do.
Bloomberg's Michael McKee, fantastic stuff. Strike action, industrial action, part of the mix there. We're seeing it here in the UK as well as what is potentially going to unfold in the US. Back to what's happening across the banking space then. JP Morgan, or at least the economics space, this is the call from JP Morgan and team, saying a soft landing is becoming the more likely scenario for the global economy than a recession. Bloomberg's Danny Berger joins us for more. Danny Berger, not a big surprise that we're hearing optimism once again from Kalanovic and team at JPM. They're saying this is risk on. The Fed made a mistake by going as aggressively as they did.
I was going to say, I mean, this isn't a different call at all from Marko Kalanovic, who this entire year has been bullish equities, buying the dip. So this just feeds into that overall argument he has formed this year, saying that, yes, the economy can reach a soft landing, kind of hitting back at those who say, listen to the rhetoric coming from the Fed before we had that blackout period. They're being hawkish, therefore not good for risk assets. Instead, Kalanovic and team write in this note from yesterday, economic data and investor positioning, they are more important factors for risky asset performance than central bank rhetoric. We maintain a pro-risk stance. They go further than that, though, and also say 75 basis points, that is an overreaction because inflation will start to cool, and that means that the Fed will pivot. Yes, folks, we're talking about the Fed pivot yet again, putting in that bullish posturing from JP Morgan. But if you look across to other analysts, this certainly is not consensus. In fact, a form of a recession feels to be more consensus. You can see that in some of the oil calls we've gotten recently. Morgan Stanley and UBS just downgraded their year-end calls. Morgan Stanley downgraded $5 to $95 per barrel for Brent. UBS a downgrade of $15 to $110 a barrel for Brent. Both of them citing recession, not necessarily the U.S., but more global issues, especially when it comes to China and lockdowns there. Both of them do see higher oil above $100 for next year because of the tight market. But Kriti, it really just shows you the divergences and nuances of this economic environment we're currently living through.
You know, it's really fascinating. On the one hand, you do have all of these recession fears pressuring the oil market. On the other hand, you have potentially a little bit of optimism that you're seeing, at least with Kalanovic. Bloomberg's Danny Berger, thank you for breaking down both sides of the story. Well, from Wall Street to Washington, President Biden trying to capitalize on a sudden spate of positive economic news. His goal is to turn his party's biggest political liability into an election year selling point. This comes as the Democrats' once unlikely bid to retain control of both houses of Congress has been boosted by falling gas prices and signs that inflation may be easing. Joe Matthew, Bloomberg Washington correspondent, joins us now from D.C. for more. Joe, walk us through it.
Yeah, this messaging from the White House, Creedy, has really been evolving for a couple of months now as President Biden and his economic advisors point to what they call one of the strongest economic rebounds in history. And while they defer to the Fed for all things inflation, they point to two real factors to make the case: the hot job market and, to your point, lower gas prices. The president will make the case for these today, and for the billions of dollars being invested in climate and infrastructure when the White House holds a celebration today on the South Lawn for the recently passed Inflation Reduction Act. Now, Republicans, of course, continue to hammer President Biden on inflation, and Democrats at large as we head for the midterms. That part's not going to change. Timing is everything, though. The event will follow this morning's CPI, obviously, and that may or may not bring the good news that the White House is hoping for. Also, as Michael McKee just mentioned, there is a possible looming rail strike at the end of this week. If that were allowed to happen, Creedy, that would create massive supply chain problems and could undo all of the progress that's been made on that front.
Yeah, Bloomberg's Joe Matthew not necessarily plain sailing, even though the economic picture is looking a little brighter for Biden and team. You can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio, of course. Now, Ukrainian forces have recaptured more than 6,000 square kilometers in the east and south of the country so far this month. Ihor Jovka, advisor to the Ukraine president, spoke to us yesterday.
We need more weaponry. We need more artillery. Artillery matters when starting those kind of campaigns. We need ammunition, necessary ammunition for the Western artillery and for the old Soviet artillery. We need armored vehicles and tanks, because you see how important to have enough armored vehicles and tanks to carry the manpower. So definitely we need more and more weapons from our Western allies to get our victory as soon as possible.
OK, that was the advisor to the Ukrainian president speaking to Maria today, who joins us now, our European correspondent, for more on this. Maria, your assessment, having spoken to this key advisor to the Ukrainian president, is there a sense now within the team there, the team in Kyiv, that they can actually win this war?
Well, Tom, wars are unpredictable, but the one thing that has not changed in the eyes of the Ukrainian government from day one is that they can win the war. And I think we need to remind ourselves that for many Ukrainians and this administration led by President Zelensky himself, this is an existential question. They really do believe this is the battle and this is the fight for their lives. And for Ukraine, I hear this repeatedly. This is not just war talk. This is not about hyping up the people. They really believe there is a sense of that going forward. I also think in that interview that I conducted with Ihor Jovka yesterday, he advised Zelensky on diplomatic matters. He also said at this stage, it should be clear now to anyone who doubted us that we have a professionally trained army that has been on high alert ever since Crimea was illegally annexed by Russia. They know how to operate NATO weapons. And he also pushed back on this idea that more weapons means escalation, and that could lead to more violence. And the way that the Ukrainians see it, the only way to get Vladimir Putin to engage diplomatically will be to defeat the Russian army on the ground. There is no other way to go about it.
Bloomberg's Maria Tadeo joining us from Brussels. Thank you, as always. Let's talk now about UBS, set to raise its dividend for this year by 10% and saying share buybacks will likely exceed $5 billion in 2022. The Zurich-based lender is returning excess capital to investors following the cancellation of its Wealthfront acquisition. Michael Moore, Bloomberg Finance editor, joins us now for more. Michael, a lot of changes at UBS. Walk us through the details.
Sure. So I think for investors, this kind of cushions the blow of the Wealthfront deal not going through. And you've seen from a number of banks in Europe, despite the economic fears, despite the concerns about a potential recession, they are returning more capital to shareholders. That's something that was put on pause during the pandemic, but there is a lot of appetite to get that capital back to shareholders after years of promising it.
Meanwhile, Michael, Credit Suisse, embattled Swiss lender, of course, is looking to raise money with a bond deal. Is there appetite for that? What are they going to put in that money to play for?
Yeah, so it's not just Credit Suisse, it's a number of lenders but Credit Suisse is leading that effort. And this is part of the leverage buyout loans that we've seen over the last few months really come under pressure. This will be a good indication of the market for that kind of debt and whether banks can get some of this off their balance sheet They've taken a number of write-downs in that area in the second quarter. But if the market for that comes back a little bit, that could be very bullish for Credit Suisse and the other banks.
All right, Bloomberg's Michael Moore, thank you so much. Let's turn now to another corporate story we're watching this morning. Twitter has rejected a third attempt by Elon Musk to cancel his agreement to buy the social network. According to the filing, Twitter says Musk's latest move is, quote, invalid and wrongful. This comes as Twitter whistleblower Peter Zatko, or Mudge, gets to testify before a Senate panel and Twitter shareholders vote on the $44 billion deal today. So a lot of drama that continues to unfold. As for how that is translating into Twitter shares in pre-market trading this morning, right now they are unchanged, but definitely one to watch. Another one to watch is Peloton. The company's co-founder, John Foley, who had already stepped down as CEO back in February, now also stepping down from his role as executive chairman, so leaving the company entirely. Initially on that news, when it crossed in late afternoon yesterday, the stock rose. This morning in pre-market trading, though, down about 2.25%. So investors don't seem to like the leadership change up too much. Finally, one other stock to watch, Apple, because of course this was one of the big drivers of yesterday's rally here in the U.S. It was up nearly 4% on those stronger than expected pre-order data for the iPhone 14, and those gains are continuing this morning. That stock up about 0.6% before the bell, Tom.
Yeah, customers apparently loving that iPhone 14. They've kept the price as well, Apple, and that boosted the share price. I say thank you. Coming up, of course, investors will be closely eyeing the US inflation print, as we've discussed, for clues on whether the Fed will deliver another jumbo-sized rate hike next week. We will discuss with Ryan Wang, US economist at HSBC, and how inflation is upending politics in the most unequal region on Earth. Read more of today's Big Take story about Latin America on Bloomberg.com or by typing NI Big Take into your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Tom McKenzie in London. Anna Edwards and Matt Miller are off. Well, it's CPI day, which means, of course, we have to look at those inflation expectations. Largely baked into the market right now is the expectation that CPI, well, it's peaked. It's in the rearview mirror. Now it's just coming down. The question is, how quickly can we get it back to some sort of normalcy? Let's take a look at what the market is pricing in, though. For our radio audience, stick with me here. We're looking at a chart on the Bloomberg terminal of 3-year inflation expectations and 1-year inflation expectations. And on both, you can see that they have kind of peaked. They're saying that now you are going to start to see this deceleration in CPI. But as Michael McKee pointed out earlier in the show, CPI, headline CPI may be decelerating, but core numbers, that part that the Fed really watches, that might be accelerating a little bit. Let's get some market reaction, or at least the thought process on what the market reaction might look like from our very own Simon White, a Bloomberg macro strategist. He joins us now. Simon, your take.
So I think the inflation worm is turning. You point out the expectations index there. That's clearly falling from the NY Fed, but there's other surveys that are all confirming the same sort of thing. So, you're beginning to see this kind of rolling over in inflation expectations. The Fed also produced a global supply chain index. That's also been rolling over quite significantly. So you're seeing multiple things lining up, suggesting that at this particular stage, we're seeing inflation peak for now.
So bonds looking oversold to you at this point?
They're extremely oversold. I mean, I had looked at a chart today. I had to put another line in to show how oversold it was. And I think that's the potential with the traders. You look at 10 years at 330. They've obviously been selling off recently. I don't think the market is particularly ready for a downside surprise to CPI.
Okay, there you go. The trade is at the long end of the bond market. If you start to see, as you say, the worm has turned on inflation. That's the call there from Simon White, of course, our macro strategist. Thank you very much indeed. For more market analysis, of course, check out MLive Go on your terminal. Plenty of great stuff there. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Tom McKenzie in London. Matt and Anna are out today. Now, keeping you up to date with news from around the world, here's the first word. Goldman Sachs doesn't see China shifting its COVID-0 policy this year. In a report published today, Goldman says that stability will be the prevailing narrative in the lead up to next month's key Communist Party meeting. COVID containment measures, especially around Beijing, have been intensified in recent days. Bloomberg has learned that the Justice Department has subpoenaed dozens of former President Trump's campaign operatives and allies. It's part of an effort to collect information related to the plot to overturn the 2020 presidential election. A lawyer for one of those subpoenaed, former New York Police Commissioner Bernard Kerik, calls it a fishing expedition. And Deloitte is forecasting that U.S. retailers will see slower sales growth this holiday season because of inflation. The consulting firm expected a 4 to 6% increase in holiday sales. Higher prices are expected to drive more consumers online to search for deals. Coming up, we'll continue the conversation on inflation ahead of the critical CPI numbers here in the U.S. coming up in just over 3 hours. Ryan Wang, U.S. economist at HSBC, will give us his thoughts. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. US inflation probably slowed for a second month in a row, but that is unlikely to keep the Fed from another jumbo interest rate hike next week. A risky pivot for President Biden. He's trying to capitalize on positive economic news by turning it into an election year selling point. Meanwhile, JP Morgan says a soft landing is more likely for the global economy than a recession. And UBS will return excess capital to shareholders after the collapse of the Wealthfront deal. The Swiss bank is raising its dividend and will probably exceed a target for share buybacks. I'm Tom McKenzie in London. Kailey Leinz and Kriti Gupta in New York. Anna Edwards and Matt Miller are off today. Kriti, it is that CPI print that is driving market action today. The expectation that maybe inflation has peaked in the US.
Well, just maybe. A little bit of cautious optimism certainly afoot, it seems like, in the markets. When you're looking at futures, they're up about 0.3% on the S&P 500. But to me, I think the cross-asset story is crucial here because take a look at what the 10-year yield is doing. Not much relative to volatility that we've really seen. 331 on the 10-year yield, only down about 4 basis points. And I think with that move, you are seeing a little bit of weakness in the dollar today. But once again, it is marginal. So really kind of keep your eye on that key pivot point that we are going to get in, well, just about 3 hours, as Kailey pointed out. Crude futures also, once again, cautious optimism, that risk rally, if there is indeed one like there was yesterday. What's the cross-asset story? Stocks and oil on the same page. 88 handle on NYMEX crude, up about 1%. And the one anomaly this morning was what Bitcoin was doing. When you have a risk rally, Bitcoin is usually on board. This morning, it was not. It was down 0.6%. Now you're seeing a little bit of those losses get paired. Still in negative territory, but only down about 0.2%, Kailey.
All right, Kriti, well, I want to return back to the stock that was the big driver of the rally yesterday, and that was Apple. Some more positive data on pre-orders for the iPhone 14, lifting the stock nearly 4% yesterday, and those gains are continuing in early hours this morning, up about 0.6% before the bell. Other big tech stocks are gaining as well, including Tesla, only up about 0.2%, but of course it is a heavyweight, so that does add to the futures move we are seeing. And of course, the company's CEO, Elon Musk, continues to be mired in a very dramatic battle with Twitter. Twitter yesterday rejecting Elon Musk's bid to abandon his $44 billion deal for the company again for a third time. And of course, shareholders of Twitter will be voting on that deal today at the same time that Twitter whistleblower Mudge is going to be testifying in the Senate. So a lot is going on. All of it, though, adding up to Twitter shares unchanged right now in early hours this morning. And one other tech stock to keep an eye on is Peloton. The company's co-founder, John Foley, who already had stepped back as CEO earlier this year, is now leaving the company entirely, stepping back from his executive chairman role. Initially, the stock gained on that news, but it is lower now in pre-market trading by about 2.25%, Tom.
Kailey, here in Europe, you're looking potentially at 4 straight days of gains now across the benchmark. Gains of 0.2%. Of course, what happens on the CPI data front will, of course, be consequential in terms of how this plays out towards the end. And the close, you're also seeing some pretty decent strength for the single currency. Yes, dollar weakness, but also maybe some expectations that there's going to be some resolution, at least policies put in place in terms of trying to cap these energy prices here. 101, and you've seen natural gas futures coming off a bit in Holland. Gains of 0.4% for the single currency. One corporate story to bring to your attention attention here is the British retailer Ocado being absolutely hammered, down almost 11%, 10.5% as things stand, on the back of falling consumer demand, the pinch, as that cost of living crisis really becomes apparent here in the UK. UBS, on the back of that buyback story and the raising of the dividends, share buybacks as well after they scrapped that deal, gaining 1% for the Swiss lender.
Certainly something we're going to keep an eye on. But at the end of the day, really, Tom, it's what we've been talking about all morning long. That pivot point is going to come from the CPI report. Let's get a little bit of a preview, if we can, with Ryan Wang, U.S. economist at HSBC. He joins us now, waking up bright and early for us. Ryan, thank you, as always, for making the time. I'm curious about the CPI data, though, because in the last report, a lot of the move came from the commodity space, which in turn came from a stronger dollar. I'm curious about what is actually going to drive this deceleration.
Right. Well, I think what markets are hoping for and what they're looking forward to is they've seen some evidence of declining pipeline pressures, right? So these are things like commodity costs for items like steel and lumber, declining freight costs, some evidence potentially that this extreme tightness in the labor market that we've seen over the past 12 to 18 months may be alleviating. Now, one wrinkle here is that not all these prices that we're talking about are consumer prices. They're more raw materials, pipeline measures, and if there's anything we learned about inflation is that the pass-through of these costs doesn't move in a straight line. So I'm actually a little bit skeptical that we're actually going to get this big deceleration in the monthly rate of inflation that markets seem to be anticipating.
Well, Ryan, on the subject of energy costs, of course, that's not just a U.S. problem. They're dealing with it in Europe as well. And we are just having some breaking headlines crossing the terminal that the EU is mulling 180 to 200 euro price cap on power from lower cost sources. And they're also eyeing taking 33% of extra profit from fossil fuel companies. So that is how they're grappling with this on the other side of the Atlantic. Returning to this side of the Atlantic, though, here in the U.S., you say you're a little skeptical about these forces coming in to lead a deceleration in inflation, which brings me to the fact that this isn't just about one monthly report. It's ultimately where inflation is going to be able to get down to. Ryan, how long do you think it's going to be until we're near that 2% target?
I think it's going to take quite a while. You're absolutely right. I mean, what we've seen over the course of recent months is a little bit of a rotation away from elevated goods price inflation and towards services inflation. That includes things like rents. Housing costs are very important for the U.S. consumer, and also all types of services that are impacted by that tight labor market and by rising wage costs. That's also feeding through into the inflation numbers. So if you look at the core inflation metrics that the Federal Reserve likes to pay a lot of attention to, you see today's core CPI inflation rate, it's running close to 6%, that core PCE measure running close to 5%. And I think in both cases, it's going to take well over a year before we see meaningful progress lower. In our minds, we could be talking about well into the middle of next year where we're still looking at a core PCE rate of over 4%.
Wow.
Wow, well into next year. So the labor dynamic within that, Ryan, where does unemployment need to get back down to that rate of 2%?
Well, so that's the interesting question, because there are multiple measures that we have to watch right now to see whether labor market conditions are softening. And that is the intention, or one of the key intentions, of tighter monetary policy. But that could include a decline in the number of job vacancies, as you mentioned, a rise in the unemployment rate, or simply a deceleration in the wage gains. The fact is that we haven't seen the type of labor market imbalance that we're seeing right now in many decades. So we don't exactly know how it's going to play out. We don't know the question, or the answer to the question, of how far does the unemployment rate need to rise. Now, the starting point was about 3.5%. So clearly, if you talk about a rise in the unemployment rate towards 5%, well, you're already talking about over 2 million jobs in terms of that gap. So, that's a benchmark that I would clearly be watching closely to see whether that's in fact what's going to happen to the labor market as we move through the rest of this year and into next.
Ryan, are you concerned about a fiscal response at all? I mean, we talked a lot about this when President Biden's loan forgiveness plan was taking a little bit of heat. We've talked about this from Elizabeth Warren and the comments she's made. And of course, this is something that Europe specifically is dealing with, this kind of divergence between monetary policy and fiscal policy. Are you concerned about the same happening here?
Well, that's an interesting point, and you know, you just raised this topic of course the fiscal policymakers in targeted areas are trying to alleviate the pressures that are associated with high inflation, whether that comes in a broad-based fashion, and again, this breadth of inflation is very important, or whether it's in specific key household necessities like energy, and of course food costs have also risen very, very sharply. So you can understand the impulse of the fiscal policymakers to kind of lessen that pain for consumers and households. But from a broad-based macroeconomic perspective, of course, that doesn't fundamentally address the imbalance between supply and demand, which is at the heart of why these costs and prices are rising.
All right, Ryan, we only have about a minute left. I want to return to monetary policy specifically. A, is it going to be 75 for the Fed this month? Will that be the last 75? B, and ultimately, what will the terminal rate be, and for what duration do you expect they will stay there?
Well, Fed policymakers have been very careful not to definitively settle the question of 50 versus 75 basis points at next week's policy meeting. What they've been more clear about is the second question you asked, this idea of likely moving the policy rate at least to 4%. And so that's 4% with potential upside risks if inflation doesn't fall as quickly as the market seem to be expecting at the moment. And so that's kind of the baseline that I would expect, that by the end of the year, we're very, very close to 4%, and that policy rate, as we've heard so many times from Fed policymakers, is more likely than not to stay at that elevated level through all of next year.
Okay, 4% by the end of the year is the call from Ryan Wang of HSBC. Of course, if we look ahead and preview that CPI number out of the US. Thank you, as ever, Ryan. Coming up, inflation will remain stubbornly higher than the markets are expecting. That is the view from Bridgewater Co. CIO Greg Jensen. More from our interview next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former U.S. Defense Secretary William Cohen. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Tom McKenzie in London. Matt Miller and Anna Edwards are off today. Now, Bridgewater co-CIO Greg Jensen predicts that inflation will remain stubbornly higher than the markets are expecting. Jensen spoke with Bloomberg's Sonali Basak at the SALT conference here in New York City yesterday.
When I look at markets, like all investors are thinking different things, but you can kind of aggregate market sentiment just by looking at what's priced in and comparing what you think will happen relative to that. And so I think the biggest mistake priced into markets right now is the belief that we're going to return to essentially pricing similar to pre-COVID, that inflation is expected in markets to come down to a little under 3% over the next 18 months or so, and that that'll happen without much of a recession. So earnings are priced to continue to grow at a relatively normal rate from here. So I think that is probably the biggest mistake being priced in, which is things can revert normally, that we've had the drawdown and the worst is behind us. I think that's actually a mistake. We're still in the early phase of dealing with a radically different world than we had pre-COVID, a world that's deglobalizing rapidly, that's definancializing in certain ways, that is short, still doesn't have enough energy in a lot of places in the world for relative to economic conditions before. And we're working our way through that process. And so just like the phase, you have a 30-year phase from 1982 to 2008 of lower interest rates and higher private sector debt. You had a phase from 2008 basically up to COVID of the shift of private sector debt onto the government balance sheets through quantitative easing. And then you have fiscal policy and monetary policy come together to create an explosive mix of demand outstripping supply post-COVID that led into this inflationary environment, which is a challenge for policymakers where they no longer can get what they want, which is essentially low inflation and reasonable growth, and therefore they're constrained. And the markets aren't pricing for how constrained policymakers are, how actually impossible what markets expect, reasonably good earnings growth and low inflation to come in a combination are. So I'd say that's the biggest mistake.
Bridgewater co-CIO Greg Jensen speaking with Bloomberg Sonali Basak at the SALT conference in New York yesterday. And lucky for us, Sonali is joining us now here on set for her top takeaways from the conference. So great interview. Putting together that conversation and everything else you heard yesterday, what were the key themes?
A lot of bearish views. And I think Greg Jensen gave us 20 minutes of rationale of why things can get worse. Remember, Kailey, you talked to him just a few weeks ago about that potential 20 to 25% future drawdown. He really also said that markets are not pricing in all the risks tied to Europe, so that's a big risk ahead, as well as that stubbornly high inflation that you heard him talking about. I would also throw in the midterms there and the investment that Bridgewater is putting in with views on policymakers and fiscal policy on top of monetary policy that markets are so focused on. I would also say later today is very interesting over at the SALT conference. In addition to the bearishness that we heard not just from Greg Jensen, but also from Anthony Scaramucci himself, who runs the SALT conference, it will be interesting to see what Todd Boehly tells Eric Schatzker during an exclusive panel that is at 10 a.m. Highly watched because not only is Boehly very popular right now as an investor because he really led a lot of other investors into European football, if you will, with that purchase of Chelsea. But remember, Todd Boehly also sold a massive CLO asset this year. So he's been deal making on the side of Chelsea. And I think the question today is he going to be Todd Boehly, the sports owner, or is he going to be Todd Boehly, the private equity titan, or is there a merger of both worlds, if you will?
Well, you just said merger, and that triggered me because all I have on the brain today is merge ahead of that for Ethereum. We're going to be talking about it on Bloomberg Crypto later. You will be joining us for that. What did you hear on crypto at the conference?
Of course, a lot of crypto, because remember, FTX Ventures is taking that 30% stake in Skybridge. And when Anthony Scaramucci did talk to the folks, the press over at SALT, he talked a lot about that FTX deal and what it meant. He said the $40 million worth of crypto that they bought on Friday was already worth $50 million by Monday. And so the question is that hold? Remember, that is a very significant stake. Anthony Scaramucci, the last time he tried to sell a stake in Skybridge, it was because he had joined the Trump administration for that short stint. And so this is a very different type of deal, if you will.
Well, Sonali, I want to talk about the banks here and pivot a little bit. UBS raising their dividend, exceeding their buyback, even as their deal collapsed. You've covered banks for ages. Walk us through your take.
So I think the one common theme here is that bearish sentiment and what investors are doing to counter that. And what you're seeing over at UBS is so interesting because even with a scrap deal, a scrap merger, you are seeing them say we're returning capital to shareholders and the market react well to that. What does that mean ahead? Are investors going to reward that capital return, or are they going to reward companies investing in themselves via M&A? To the extent you see more positive reactions like this, as you're seeing with UBS, you're going to see more companies using that dividend buyback plan more than you are seeing them use the M&A button. And I think that Credit Suisse deal, as it kicks off today, that big investor call at 10:30 a.m. this morning about that, big bond sale tied to the Citrix buyout will also really set the tone ahead for future deals, especially as it pertains to large leverage buyouts that require a lot of financing that can be quite expensive as the cost of borrowing rises.
The theme here is buybacks, it's dividends, it's bond issuance. And it almost feels like there's this big move, perhaps, especially from the European banks, to somehow broaden the investor base. Walk us through that at a time when, on a macro front, we're talking about these massive issues isolated, arguably, to Europe.
Yeah, I think that's a great question because there has been a question of whether the problems in Europe would flow back to the United States. Right. Remember, when you look at the U.S. banks, the reason the Citrix deal is so important is because they don't have as much of a blocked pipeline as you're seeing over in Europe. The financing markets are a little more open here. Do they stay open? I think what's interesting is if you look at UBS's share price year to date, it's not that bad. It has not declined all that much. So it's showing you either, there's a clog in the wheel here, there's a clog in the pipeline that will open up eventually, or there are worse things to come that are not being priced in yet, as Greg Jensen says. It's only time that it will tell you what the truth is when it comes to the Europe versus US market, when it comes to issuance and future pipelines.
Sonali, we also heard from the CFO of HSBC on the need for cost cuts. Well, they have to raise wages, but also they have to cut costs, and they're not on target yet. You link that to what's happening with Goldman Sachs, and I know you were talking about this yesterday. Where does that leave us in terms of the need for these for these big Wall Street banks and the banks here in Europe as well to trim some of these costs?
I think that's a great question, Tom, and I've been thinking about it all morning because if you look at what's happening at Goldman Sachs, it's a very different story from HSBC. For HSBC, they're cutting costs, they are, keeping a handle on headcount, and that could result in brutal cuts. But when you're looking at what's happening at Goldman Sachs, it's really just a return of the culling that we have seen in prior years. So if you think about the cuts that we've seen over at Goldman and other banks in big recessions, those cuts can be very big, and that is not what we're seeing right now. So while the cuts can be painful, Tom, it is the truth that it's not very steep yet, and it's really a matter of competitiveness and headcount control at a time where they're still growing. Whereas HSBC and a lot of the European banks here, you are seeing them cut not by the hundreds, but potentially the thousands. And that's also what we're seeing over at Credit Suisse potentially this year. And investors are rewarding some of these plans because, again, they want to see that return of capital to them and that clamp down on costs at a time when profitability is also under pressure.
That's really interesting, that divergence between what is happening in the US versus what's happening in Europe. And it's just remarkable just how quickly we've turned around from banks saying they are desperately on the lookout for talent to now trimming headcount. So to what extent do they become overstretched when it comes to adding additional talent, or is it very specific departments when you're looking at those Wall Street banks?
That's a great question because a lot of this pressure is on underwriting teams. It's on equities. It's on debt underwriting teams that have been really under pressure. SPACs have been virtually non-existent. And Credit Suisse, remember, I would also say a lot of their underwriting was tied to China. And so it's regional. It is absolutely tied to business lines. I would point out that a note that Jefferies had sent around to their employees a couple of weeks ago got a lot of attention because what they said is we've hired a lot and we want to keep everyone on staff that we've hired so that we can work really hard when deals return with the expectation that deals do return. So to the extent that that market gets more pressured, I think that's when you really start to worry about the job market in a bigger way. But for now, there are a lot of executives that want to keep a lot of their top performers that they, as to your point, have just hired on staff as they prepare for that market to return.
Okay, the always excellent Sonali Basak, thank you as ever for walking through some of the key themes across the banking sector. It is Tuesday, so don't miss, of course, Bloomberg Crypto, as Kailey was flagging for us today. 1 p.m. New York time, 6 p.m. in London. Today, we're going to hear from Ethereum co-founder Joe Lubin as we count down to Ethereum's much anticipated software upgrade, the merge. This is Bloomberg.
Women are saying, I can't do my job at the same intensity as before or at all if I don't have safe and affordable childcare. That is just a problem. And so we've pushed women out of the workforce, and we have so many girls across the world who are not in school anymore.
Melinda Frenchgate speaking to Bloomberg Technology's Emily Chang. Frenchgate saying the pandemic has stalled progress on critical issues like poverty, climate change, calling gender inequality, quote, the most alarming. Of course, that is going to feed into concepts like wage inflation, for example, which brings me into what I'm watching specifically, what we all are watching. Of course, the CPI print is going to be the major pivot point this morning, just under 3 hours to go. A little bit of a deceleration on the headline numbers, Kailey, but then at the end of the day, perhaps a little bit of a bump in the core.
Yeah, so I'll be watching that data too in about 2.5 hours time. But later on today on Bloomberg Crypto, I'm going to be all eyes on the merge, Ethereum's upgrade, shifting them from a proof of work system to a proof of stake system. Tom, we'll be speaking with co-founder Joe Lubin about that later on.
Yeah, really important interview. I'm focused on what's happening in Fosun. This is one of the biggest private companies in China. Does this mark another shot across the bow for the private sector from Xi Jinping? Stay with us, plenty more coming up. This is Bloomberg.